Welcome to Global Risk Community Chat. Today we are joined by Sidharth Kamani. I'm very pleased to have you here today, Sidharth. Welcome.
Thank you, Ajay. It's my pleasure to be here.
Yes, likewise. I'm very happy you joined us. Before we start with the topic, can you briefly introduce yourself to our audience?
Sure. Yes. So, hi, I'm Sidharth Kamani. I'm a risk professional. I've been working in the field of risk for about 10 years. I'm FRM certified. I'm currently working with the New Development Bank, which is a multilateral institution set up by the governments of the BRICS countries. Our main job is to effectively give long-term infrastructure loans to our countries and to even non-sovereign clients. So this obviously includes a lot of credit risk, which is the area that I've been focusing on, including some risk-related advisory at the management level. Prior to this, I was with Goldman Sachs, where I was looking at market risk and liquidity risk. And I got a chance to work hands-on on multiple regulations such as the CCAR, the LCR, and the NSFR. And my interests lie in the spaces of infrastructure finance and digital infrastructure finance. Thank you. Yeah, maybe Ajay, just one last thing from my side.
Yes,
the standard which always applies, that I'm speaking today in my own personal capacities and the views expressed in my own. But it was so nice to be a part of this podcast. Thank you so much, Ajay, for the opportunity.
Thank you so much for sharing your background expertise with us. What topic would you like to discuss with us today?
So I think I have an interesting topic for risk practitioners today. There's this rapid development that's happened in the area of credit risk specifically. So traditionally, a large part of the population has always been left out in terms of not being able to get loans from the traditional banking system. And this is because they don't have sufficient history in their credit file or they don't have credit scores. So typically banks rely on credit bureaus to provide them with credit scores to decide whether a borrower is eligible to be able to borrow from them. So if you think of millennials or students, farmers, typically they find it more difficult to find loans. So they are excluded. There's this massive improvement that's happened now in financial inclusion just because of the availability of data and the and improvements in the ability of institutions to analyze that data using artificial intelligence and machine learning. So these big technology companies like Amazon in the US, say Alibaba in China, Paytm in India, and many others across the globe, they are now able to use their technology platforms and their payments platforms to actually gather enough data and to analyze data to do credit assessments. So potentially the number of data points runs into thousands, but the amount of time required to do the credit scoring is seconds.
Yeah, that actually sounds quite interesting. What are some perhaps key things that you can share further about this topic, about perhaps how AI is included in or how this whole thing works with credit risk assessment?
I think one of the important things to think about is are these the alternative assessments, are they as good as the traditional models in predicting default? At the end of the day, credit risk is about predicting whether a default will occur. And are these new models able to do that? So there is this interesting comparative study that was done by the BIS, the Bank of International Settlements, which kind of concluded that yes, in most cases, it is better than, if not at least equal to, the traditional models. But in spite of that, we have to identify if the models, even though the models might be good, and even though they might be bringing about huge social, economic, positive impacts, are there other things that we should be concerned about, some negative externalities? For example, privacy. Are the models able to eliminate bias effectively? Are there hidden biases in the underlying data? Unknowingly, are the models discriminating on the basis of gender, income, geographical location? So we should be maybe honest and humble to acknowledge that models can be imperfect and that over-reliance on models can sometimes lead to suboptimal outcomes.
Yeah, that's actually quite right. I never really thought from that point, especially about the humble part. It's quite interesting to hear. And if you want, you can go a bit more deep into the topic, not by much, of course, due to time constraints, or especially on the sense of what would be one takeaway that is particularly worth implementing for our viewers, like especially for the ones that are working in credit risk. management?
Right. I think one of the important things here, which goes in line with the humility, right, is the fact that let's work with our regulators. I think one thing that's quite well understood is that when it comes to data and how data is being leveraged by fintechs, big techs, neo banks, challenger banks, one of the things is that regulation is kind of catching up. But it's important for all of these stakeholders, especially in the credit risk space, or in the risk management space, to work closely with regulators to make sure that we are maximizing the benefits while minimizing the risks of technology adoption. So the benefits of technology are maximized when it is available for everyone to share. And this is a very good example of how technology is changing the very nature of financial intermediation.
Yeah, quite, yeah, true. It's considering how much your technology has been improving. Then I will add up a additional question to that, which is looking now at these trends, these technological advancements. Can you perhaps like predict what might come, new trends that might come, anything in regards to the future of credit risk?
So I think with the development of technology and the data that we have and our ability to analyze that data, it's only going to get better and better in terms of financial inclusion, right? So more and more people are going to become a part of the system, but at the same time, there's going to be more competition. It's going to be a very customer-centric kind of system that's going to evolve. Customers are going to be able to freely, I mean, not freely, but are going to be able to, with more flexibility, have the options of getting loans now from multiple different avenues. So not just from traditional banks, but from big techs, fintechs, all of these guys who are now looking to give loans to them. And this could also lead to maybe better assessments, because the one thing about data is the more data there is, the better its capability to predict. So I think it's only going to get better and better with time. The ability to predict defaults will get better, and the ability for customers to get loans at cheaper rates is probably going to get better as well.
Yeah, that's some good predictions. Thank you so much. Then I have just one question remaining, which is that since it's kind of getting at the end of the time, how is it for you to be part of a risk community in general? Because I, of course, hear that you've been working in risk for over 10 years with 10 years plus expertise. How it has been for you from a community perspective of things?
I think it's great. You know, one of the things that happened probably from the financial crisis of 2008 onwards is that risk management has been at the forefront of the banking model, right? And also the closeness to regulators has increased significantly. There's massive developments that are happening in how we are regulated, in how how risk management is taking care of all the different types of risks out there, whether it's financial, non-financial, etc. So effectively, I think what I'm trying to say is that the community aspect of risk management has truly benefited. I'm very privileged and honored to be a part of this community. One of the biggest advantages is that it's a very good forum for every stakeholder to come and say, these are my individual challenges, and then to together solve that collectively. I think that is the community aspect of risk management that I truly like.
Well, that sounds super nice. And since I'm also, of course, since risk community in general, we are happy to have a person like you as well that is thinking in this way about being part of the community. And yeah, that's kind of concludes the chat for today. So thank you for joining us today.
But it was so nice to be a part of this podcast. Thank you so much, Ajay, for the opportunity. I'm really glad.
Thank you as well. Likewise, we are looking forward to seeing more from you, your articles and everything as well. So yeah, thank you.
Thank you.